Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 294 of the Independent Advisors Podcast, where Mark McEvely and I, Matt Jessup, bring you everything you need to know from the past week in the world of financial markets and financial planning. Mark is attending to other business matters here at the practice today, so we're blessed to have Nick Whitaker, Head Director of Research and Trading, filling in. Nick, welcome.
Good to be back, as always.
What a day. What a day to have the podcast, right? You have formal tariffs announcements yesterday, initial market reactions that we're going to get through. But before we do that, you want to talk about pricing?
Yeah, absolutely. As always, we go through the pricing at the beginning of the podcast, and this data is from Y Charts as of yesterday's close, yesterday being 4/2/25. The S&P 500 was up 1.1% month to date and down 3.6% year to date. The Dow Jones Industrial Average was up 0.5% month to date and down 0.7% year to date. The NASDAQ Composite was up 1.7% month to date and down 8.9% year to date. The iShares Russell 2000 ETF, think small caps, was up 1.6% month to date, down 8.3% year to date. And the Vanguard FTSE All World ex-US Index was up 0.5% month to date and up 6.2% year to date. Checking in on the Treasury market, the 3-month rate is sitting at 4.32, the 2-year rate is sitting at 3.91, and the 10-year Treasury rate is sitting at 4.2.
And I know that obviously we're going to talk about it here in a second. I know there's a lot of, uncertainty with some of the headlines that people are seeing, not only over the past 24 hours, but, past couple of months. So, before we get into the show, listeners, if you've been enjoying the Independent Advisors Podcast for a while now and want to take the next step in your financial journey, I'd encourage you to head to our website, jessupwealthmanagement.com. I myself, Matt Jessup, I'm offering 15-minute initial calls where you can discuss your financial goals and see if JWM could be a possible fit for your needs. Scheduling's easy. Once you land at the jessupwealthmanagement.com website, just click on Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure our time is used efficiently. And if you're ready to learn more, visit jessupwealthmanagement.com and book your call today. So I thought that would be timely given these headlines that we're about to discuss. Yes. I'll start with the elephant in the room, which is obviously the reciprocal tariffs that were put on by the administration yesterday at 4 o'clock. To very much say it simplistically, it appears the administration's goal is to reciprocate with half of the existing tariff that country has on the United States. And my editorial slant now, this is my opinion. My opinion is this is a classic Trump tactic of a deal of employing leverage. And he is instilling a penalty that's pretty steep for these countries in hopes that they lower the tariffs they have on American goods. And a byproduct of that is he's hoping that it spurs more domestic production, right? More onshoring. My further thoughts on the comment is obviously when you do such a thing, it comes with risks that countries don't lower their tariffs, that a trade war blows out of hand. And, one would think that maybe the administration might have a couple tricks up their sleeve from a consumer consumption standpoint to spur, spending if things do get out of control. But what it leads to me in the short term, obviously, is this uncertainty till things are probably negotiated over the coming weeks. And here's my biggest words of wisdom. Anytime you see uncertainty spike in these markets, it has always served me well over the decades I've been in this business to take a step back and try to not overtrade and time the market. That is initially the thoughts that came to mind over the last 12, 14 hours as this news was going out there. And I'm going to give you a classic example of it this morning. The assumption by the market yesterday is that everything's going to have a reciprocal tariff, right? And so I literally get to my desk this morning and here's a notice: items not subject to reciprocal tariffs. And then the second thing here is semiconductors. So everyone's selling off these semis hard because they're all trying to come up with the estimates of what a reciprocal tariff will look like. Mm-hmm. And the market didn't even spend time to say, and I'll just read off a couple things that are excluded: copper, pharmaceuticals, semiconductors, lumber articles, just a couple things in that sentence.
Pharmaceuticals was another big area that was a concern for the market. I know some of the big healthcare companies voiced concern, some of the CEOs there. So that's another example.
Yeah, and I throw it out there, not that these things are going to be a savior for the market today. There's going to be a lot of additional selling pressure that comes to the market. Mm-hmm. But I would also really throw it out there to the magnitude of the sell-off in a lot of these names from their high water marks at the beginning of February. It does beg the question, to what degree is a lot of this uncertainty and concern price into stocks? Mm-hmm. On the flip side of it, I feel it would be a naive, let's just say, stance to assume that the administration has the pain threshold to really, really take the economy into a sustained bear market and a recession that really lasts. Remember, the definition of a recession is 2 consecutive quarters of negative GDP growth. On the old school definition, it's that simple. Mm-hmm. And so I think with all things being said, I think we got to take a step back and let some things play out over the next week or two before larger decisions for long-term money are made. That's my initial reaction when this type of thing happens over my career. And more often than not, that tends to be a good strategy in hindsight. Doesn't work 10 times out of 10, but more often than not, that has served me well in my career.
Yeah, I agree. I think patience should be a priority here.
What else? Big headlines and events. Anything else you want to highlight?
Yeah, I mean, obviously the tariffs is the forefront of everybody's mind, and I have a piece on that or a piece on economic data, which kind of is, I think, very good for today's podcast, just to kind of get back to where we are in the economy. But elsewhere, the PCE Index, which is the Fed's preferred measure of inflation, was released last Friday. And it was up 0.3% month over month as expected. The core PCE jumped 0.4% month over month, which left it up 2.8% year over year versus an upwardly revised 2.7% in January. Mm-hmm. So that's not great. But personal income increased 0.8% month over month in February as well versus consensus of 0.4%. So the takeaway is good on the income side, on the personal income side. So on the real spending side, because real basically just taking into fact the consumer spending minus the inflation, right?
Yep.
So there. Real PCE was up just 0.1%. And bad on the inflation side, which really was the focus of the the uptick in the core PCE index. The mixed complexion of that data, I don't think the market loved from a long-term point of view. Mm-hmm. Not to say that this is driving that anything more than tariffs. Obviously, that's not the case. But this is another underlying piece of what's going on in the market, because it's going to put the Fed in wait-and-see mode or wait-and-watch mode even more so, especially with near-term price adjustments with tariffs.
Yeah,
that were to be announced. Again, this data came out on Friday, so not great on the inflation side. You know, you'll probably, if you haven't already, you might see some headlines about stagflation start to percolate.
I've already seen some this morning.
Yeah, you'll see that. It probably started a couple weeks ago, would be my guess. So it's data. We'll see where it goes from here.
There's one upside to all this. And the upside for me is you got a lot of savers out there who are getting, a fair return compared to history for, for lower risk assets.
Yeah, absolutely.
We got that we got to throw out there.
Yeah.
Right? All right. You want to go to Tweet's article and research?
Yes. Yeah.
Dig right into that.
Take us away.
So the first thing I want to remind our listeners and viewers is about just sentiment, right? Coming into this, sentiment's pretty poor. But when I say that, we have to put it into context. So there was a piece by Matt Ceramatera. We reference Matt quite often on the podcast over the years. He had a piece, Nick, from March 31st that shows the AAII survey. It's the American Association of Individual Investors. It asks a question every week. And that question is, what's your stance on the market? Only 3 possible answers: bearish, bullish, or neutral. And when you have that go over 50%, there's some really bad things going on. And if it gets over 60, there's only been about 4 instances since the track record of this has been in existence since the late 80s. So Jenna will put up this chart for our YouTube viewers. This will be in our show notes. You got to realize, listeners and viewers, that sentiment in the markets, even before the news yesterday, was at an instance of one of the 4th worst times of market sentiment being this poor since the late 80s. Nick, there's been a lot of bad stuff, buddy, that's happened since the late 80s. And so I'm in this sense that how much of the news, say, from yesterday is already priced in with such dramatic bearish sentiment readings. One thing that's going to be interesting is over the next week, if you actually see the market rally, that's going to freak a lot of people out because it's going to be counterintuitive. How can the market rally? That's when you start to see that things might be priced in. Do I think we're in for some pain, say, today and tomorrow going into the weekend? Yeah. But remember, we have money in the market, not for stuff that we need next week, not for withdrawal needs that I have a month from now. This is a part of being in the equity markets. And my concern for people is when this downside volatility happens, just like we forget downside volatility when the market's going great, this market can rip on some news change. And just as much as the administration is catching people off guard to the downside, the opposite is possible.
Yeah, random walk, anything is possible. The random walk theory is that you don't know what's going to be announced the next day. The stocks could go up, they could go down, they could stay flat. So, like you said, anything can happen, and a lot I think is priced in. And like you said, there's some volatility. I think the S&P's bidding down a couple percent this morning.
Oh yeah, I think I saw the markets anywhere from down 3 to 4.5-ish, depending upon the index.
3.6 when I checked about 20 minutes ago.
Yeah. And then look at this next chart from Bespoke that I have. This is from March 28th. It shows the consecutive weeks of bearish sentiment being above 50%. We have matched 2008. I'm sorry to tell you, ladies and gentlemen, this is a walk in the park compared to 2008. Yeah. A walk in the park.
I'm not sorry to tell you. I'm very excited to tell you that this is the walk in the park.
Okay, this is a walk in the park. So again, I question the comparables of the sentiment being this extreme, and it makes me question how much is priced in.
I have a great piece of research later that discusses some of this type of data. So I'm excited. This is perfect.
All right. I didn't know I was teeing them up, Jenna.
Yeah, you're teeing me up.
My next piece is just tech being underowned. Seth Golden, friend of the podcast, has a great research firm, Phenom. He has a chart that Jenna will put up for our YouTube viewers. This will be in our show notes. And what it does is it shows a percentage of prime book, which is hedge funds, institutions, and it shows their overall stock exposure and then overlays the subcomponent sector of tech. Nick, as you know, and a lot of our listeners who are regular, tech's the largest subcomponent of the stock market by a sector basis, approximately 30%. And what you're going to notice is relative stock exposure of the tech environment, of the tech sector, is relatively low. You have to look at this chart. You have to go back to the COVID year of 2020. And when tech allocations were this low, guess what the best performing sector was in 2020, the rest of the year after that low?
Oh, it was tech.
It was tech
Yeah.
in a big way. And here's my thing I want to throw out there. A lot of uncertainty short term. Take a step back, listeners and viewers. I want you to slice and dice all the sectors of the S&P, and I want you to tell me what is the best earnings growth sector of the market over the last several decades and in recent history. You want to take a stab at what sector that is, Nick?
It would be tech.
It would be tech. And is there concern short term that spending could get affected by all this uncertainty and the tariffs? Absolutely. But one needs to start questioning to what degree is a sell-off we've already experienced in the last 2 months pricing in that uncertainty. Mm-hmm. My last piece is about the Mag 7. The Mag 7 you might hear in the news, listeners and viewers, are those really mega cap names, large size companies, Apple, Amazon, Meta, Facebook, Alphabet. You know, those are the big names. They call them the Mag 7. Well, this chart that Jenna will put up, this is going to be from Neil Sethi. I believe that's how you would pronounce Neil's last name. And if I got that wrong, I apologize, Neil. He has a chart that shows a similar exposure of institutions, prime books versus their exposure to the Mag 7. Huge difference. My point here is whether the market turns in a week or the market turns in 2 months, one thing I would feel confident about is the names that are probably going to rebound the quickest, and the names I would have the most confidence in rebounding the quickest are these beaten down names like the Mag 7. Wouldn't surprise me. Mm-hmm. So when the market turns, I think they're going to go back to the old playbook of buying the beaten down mega cap tech. We'll see if I'm right. I saw pre-market names like Apple getting hit like 6-7% just this morning. Mm-hmm. And that's not a recommendation for or against Apple. I'm just picking out a mega cap name as an example.
Yeah, and that's obviously the biggest name in the market, and that's a driving force of the market's move this morning.
Yeah. And then last but not least, I won't harp on this. I always want to try to stay middle of the road from a political standpoint, but this is a really good chart from University of Michigan that Zero Hedge posted. Jenna will put up this chart for our YouTube viewers. This will be in our show notes. And it shows consumer sentiment survey, but it breaks it down by political affiliation, Nick. And what it does is it breaks it down between respondents, either Republican, Democrat, or Independent. And the reason I'm putting this up here is we also have to realize that it is human nature to let our feelings and sentiments pour into other areas of our lives. And we're seeing it in the investment markets. We're seeing sentiment levels for registered Republicans go up dramatically, and sentiment levels from the consumer for registered Democrats drop dramatically. This is the opposite of when Biden got in the office in 2020. Mm-hmm. You know, it takes a couple of quarters usually for those sentiment kind of surveys to kind of normalize a little bit, stop going down. And I would just throw it out there, to what degree is this sentiment and less the fundamentals? When I see a chart like this so dramatic, it makes me question that.
It's so funny. You can see the election years.
You didn't even have to. You can get rid of the years at the bottom, and you could sit there and tell me when's 2020.
That's an election year. Yeah, that's funny. Not surprising at all.
Yeah,
not surprising at all.
I'll turn it over to you.
Yeah. So the first piece I have is it's just something I read yesterday that I thought listeners might like to hear. It's from Argus Research, and they send a daily market watch. It's a huge PDF, tons of stock information, but I just grabbed the top piece here, which is they say there's time for a turnaround. The long-term trend in the U.S. stock market has been higher. In more than 40 years since Ronald Reagan became president in 1980, stocks have turned in profitable performances almost 80% of the time. The average annual gain has been 13%. The year 2024 was another winner as stocks extended a bull market that started in October 2022. But 25 is off to a dismal start, with year-to-date decline of 6% and a peak-to-trough slump of 9.5 to current levels, essentially a correction. Now, after today, we will
definitely be in the more than 10% territory.
Yeah. What is more, the recent leading sectors of the stock market, information technology stocks in particular, growth stocks in general, and U.S. stocks versus international stocks have lagged. There's always new data emerging for investors to consider, and they can modify their outlooks and strategies as needed. The new data this go-round is primarily the trade policies of President Trump and the related concerns among market participants that this economic approach could lead to recession, inflation, or a decline in EPS. We started the year with a bullish outlook, expecting normal double-digit stock market returns based on economic growth, double-digit EPS growth, and lower interest rates. The planks of our platform remain in place. Consequently, we are maintaining our call for a positive year for stocks despite the weakness in Q1. We note a change in the investment outlook, though, and we'll be focusing more on opportunities in value-oriented sectors such as financials and healthcare and in international stocks. So, to summarize, they came out and said, don't get overly worried. Everything underlying is still healthy. Most of this is a pullback on trade policy concerns and how that's going to impact EPS. And they still think the market will do well this year. And they tweaked it where they said, hey, at the beginning of the year, we thought this was going to be the playbook, but now based on what we're seeing, we think there might be a little bit more strength in some of your like value-oriented cyclical areas. That's the only tweak they had, but they still stuck to the fact that they think double-digit stock market returns this year. So I thought that was interesting.
First of all, I respect Argus. It's a good independent research firm. They usually have some good content. Secondly, I'm stealing their term of the planks of our platform remain in place.
Yeah,
You're going to hear that on the Independent Advisors podcast again in the future. I'm stealing that, Argus. Thank you. And I think third, I like the premise of the note because it forces investors to focus on not what the market's going to do this week, not the fact that the market is down low double digits since February. But again, it just takes me back to the end of the day. We invest in the stock market to earn a rate of return over the long term that is above the risk-free rate. The risk-free rate in the market right now is investing in things such as U.S. Treasury bonds. We do it for an inflation hedge. We do it so our savings continues to grow at that above average rate of return. Everything in the world comes with positives and negatives. And the market is showing the negative side of wanting to earn those long-term rates of return. The market is mark to market. Everything is priced to the day. And seeing those fluctuations day to day, I know can be unnerving. But Argus does a good job in bringing it back. And just as much as things seem bleak, especially now, but over the last couple of months, it's amazing. We could get a couple of months down the road and we could be in a full-fledged ripping bull market. Things change quickly and don't overreact if you have a solid long-term plan in place. There's your promo clip, Jenna.
Absolutely. So my second and last piece today is a little longer, but I thought this would be a really good time to explain this because this is something that I've been aware of for years, and I'm sure most of our listeners are aware of this, but it's a good time to re-emphasize this, which is the difference between hard data and soft data. And I read this article. It's from briefing.com. They have a post that they call the Big Picture that they release every couple of weeks. I'm going to read some sections. I'm not going to read the whole thing, and we'll put a link in the show notes if you want to read the whole article. I'm going to read most of the article. That we can go back and forth, but I did try to chop it down. So
we're having a TED Talk right now. We're having a TED Talk.
Yeah, this is good, and this will explain some of the bearish sentiment that you're referring to in the Michigan survey that you showed with the Republicans and Democrats, right? This makes sense. So,
and I'm going to get emails for people because I said the word Michigan. You know it's going to happen. There's a lot of OSU fans that will not be happy that I said that.
That's just an economic. It's always been the Michigan survey.
Thank you for defending me.
Yeah, it's just
please don't send me hate emails.
Yeah. So, hard data versus soft data explained. A quick summary here. Hard data measures action. Soft data measures thoughts. Consumer sentiment surveys are the best examples of soft data. Hard data matters more as a guidepost for the economy, monetary policy, fiscal policy, and earnings prospects. I'm going to say that again. Hard data matters more as a guidepost for the economy, monetary policy, fiscal policy, and earnings prospects. So economic data gets released. It depends. It can be every week. It can be quarterly. It can be monthly. It just depends on the type of publication. It's obviously very important because it helps us get a view on what's going on in the economy, but also it shapes the stock market's earnings outlook. Now that's still subject to interpretation and what could happen, but still important. Economic reports, however, they're not all equal as market movers. Some, like the monthly employment situation report, are ignition points for the market. So when you hear employment situation report, that's the jobs report that's released on the first Friday of every month. Every month.
First full Friday of every month, yeah.
Others, like the monthly wholesale inventories report, have no market driving influence. So there are hundreds of small economic data points that you could look at across the world. So the next section here is called the simple answer. In his press conference following the March 18-19 FOMC meeting, Fed Chair Powell acknowledged that, quote, the hard data is still in good shape. It's soft data, the surveys that are showing significant concerns, downside risks, and those kind of things. That's a direct quote from the Fed Chair, Jerome Powell. He added that the Fed wants to focus on the hard data and that if the soft data is going to affect the hard data, we should know that quickly. So what is the hard data? What is the soft data? In the simplest terms, hard data measures what consumers and businesses are doing, whereas soft data measures what consumers and businesses are thinking.
Bingo.
Hard data is quantitative. Soft data, which can be represented in a quantitative light, 90% of the time it is represented in a quantitative light because it just is easier to chart. Kind of have to try to make it quantitative, but it is still qualitative at its core. I'm going to say that part again. Hard data is quantitative. Soft data is qualitative at its core.
I think the best example in recent history for people, and I love to reference it, is the past 5 years. You know, COVID hit, consumer sentiment was horrible in general, but look at the hard data. People were still spending just fine.
Yeah.
And so I think it's interesting, you know, it's kind of the thought process of the chicken or the egg. Is it the soft data that eventually bleeds and affects that hard data? And I think with everything going on in the markets last couple of months, especially over the last day, is the concern is that sentiment, the perceptions, is the soft data going to metastasize its way over to the hard data? And that's why the market's priced in what it has over the past 2 months.
Yeah, absolutely. Absolutely. So the best examples of soft data are consumer sentiment surveys, which
I had no idea he was going to say that.
Yeah, which you talked about with like the bearish sentiment.
Oh, this is going to get
right? Good. So each month the Conference Board produces its Consumer Confidence Index, and the University of Michigan, that's why you said Michigan earlier, because it's from the University of Michigan, releases its Index of Consumer Sentiment. The former concentrates more on what consumers think about the labor conditions, whereas the latter tends to revolve more around what consumers think about financial conditions and their income prospects. Both ask consumers about inflation expectations. I don't think we need to throw this next chart up because we already talked about it, but generally consumer confidence is going lower, right? Soft data. On the surface, the weakening consumer confidence reports sound ominous for economic growth prospects. What consumers think, though, doesn't always correlate with what they do, not over the short run.
Correct.
So the article mentions a book here, and then in the book, the author notes that a 6 or 9 month moving average of consumer confidence levels have been a better determinant of future household spending. I think that's an interesting point.
That's an interesting point. Yeah.
I don't think I've seen a chart that smooths out consumer sentiment on a 6 or 9 month average. I'd be very interested to see that or to try to put that together. So
I think we have a task now. We'll see if we can get Ben at the office on this one. See if we can get him to work on that one.
Well, it would make sense too, because it would smooth out those really hyper volatile periods, like you mentioned, like COVID. So the next little section here was talking about real personal spending, right? So what you see in those sentiment surveys isn't actually what people are actually doing. It might take them 9 months or a year to like slowly start cutting their spending,
actually affect their spending habits.
Right. So real personal spending is hard data that captures what consumers are doing with their money and how they're allocating expenditures between goods and services. Recently, there's been a pullback in real personal spending, but it's unclear if that's simply relative to winter weather in the South or the tragic wildfires in California or something more. It would be remiss not to add that despite the recent pullback, real personal spending is still up 2.7% year over year.
But I thought the surveys were indicating...
Right.
There's a sarcastic tone in my voice there.
Exactly,
for those that are listening to a traditional podcast.
Yeah. So there's that kind of difference that you're seeing between the soft data and the hard data. Fortunately, the labor market remains in solid shape. The unemployment rate remains at a 30-year low. Initial jobless claims are at levels consistent with positive economic growth.
Can I tackle a topic there real quick?
Yeah, absolutely.
I've been getting a lot of questions over the past month regarding the Department of Government Efficiency and these potential government job cuts and how that's going to affect the broader employment market nationwide. Mm-hmm. And I was at an investment conference a couple of weeks ago, and they had various subject matter experts, economists that were speaking at this conference. And one data set that I've heard before but was repeated at this conference is as follows. They were asked what they think the government job losses at the end of the day would look like. And this gentleman responded, our estimate is somewhere between 200,000 to 300,000 government jobs could be lost when it's all said and done. And it was followed up with, if you look at the stats, every government job is statistically backed by 2 civilian positions. So he goes, in the most extreme case, you take the 300,000, multiply that by 2, because you're going to have, another 600,000 lost at the civilian side. He goes, round up another 100,000, let's call it 1 million. And he goes, in any given month in the U.S., 5 million individuals change jobs. Mm-hmm. The current amount of job openings, and I'm sure it's going to continue to take a hit, it's around the 7 to 8 million mark of job openings. I'm sure it's going to come down with uncertainty. But the message was, I don't think it's going to be as bad for the overall American economy as people fear.
Right.
And then what was going through my head is I think a lot of that is going to be definitely around, say, a 60 or 70 mile radius around Washington, D.C. is really going to feel that disproportionately to other parts of the nation.
Yeah.
But a lot of people have been asking me about that, so I want to throw that stat out there.
And that's great data. That's great insight as well. Yeah, and I read an article about that, about kind of the flux of how that could shake out when you look down to the state and the local level as well. The article that I saw specifically was the state of New York basically targeting federal workers and saying, hey, were you laid off? We need workers. So that's another little like wrinkle that I don't know if everyone is thinking about is they don't necessarily have to go to the private markets. They could go to other public markets, or I shouldn't say markets, but other
government jobs
at the state or the local level. Now, obviously, there'll be pay cuts.
Could be
most likely associated with that, but New York made that the state of New York made that. In New York City specifically, I think is what it was discussing was, hey, did you lose your job? Hey, we want you. Like,
interesting. Very interesting. So, no, didn't hear that.
Another thing to think about.
Yeah.
So the last little piece of this article just kind of summarizes it. It says the soft data provides valuable insight into what consumers and businesses are thinking, yet it has its shortcomings. The biggest one for consumer surveys, arguably, is how the respondent feels when they're how they feel when they are logging a response to a survey. So we've talked about some of the sentiment data for the past couple of months now, and I know on the podcast there's been a couple of times where I've either alluded to or I've said something along the lines of, I wonder if the data is so bad just because of people are allowing their personal beliefs seep into their forecast of the economy and the jobs. And what I mean by that goes back to that kind of political Michigan survey chart you show, where you see Democrats at an all-time low, Republicans at an all-time high, and you see this bearish sentiment. I just wonder if people are just a little emotional for one reason or another. And I'm not saying that they shouldn't be emotional. I'm not saying that. I'm just saying that has likely seeped into the data because the whatever Argus said, the planks of the platform or the planks of the economy
are still in place for them.
Still in place. The hard data is still hanging in there. Now, inflation ticked up a bit last week. We don't love to see that, but it's still at 2.8%, and rates are at a relatively healthy level. I mean, nothing that's ringing alarm bells. So, now that being said, a prolonged weakness in soft data should not be dismissed. It can mark an important inflection point in the economy, particularly if there's coincidence and or coincidence with layoffs and rising unemployment. But that's, again, if the hard data follows, right? You need the hard data to back it up. The adage that action speaks louder than words rings true in the examination of hard and soft data. Hard data captures action, soft data captures words. Both matter, yet hard data matters more as guideposts for the economy.
Little did you know how timely this piece was going to be in light of everything. That was great, Nick.
Yeah, I thought that would, and this is something that I studied years and years ago, but it's nice to throw that out there and just remind listeners, with these bearish sentiment, it's helpful, but it's forecasting a lot of times. And as we know, and Mark talks about this all the time, forecasts are wrong.
A lot.
So don't allow those charts to have you running for the hills. Stick to your long-term plan. And hopefully that, if listeners didn't know, or hopefully they learned something, and if not, it's a good reminder.
Great piece. That was a great piece. Jenna, we need to get a shirt for Mr. Nick that says hard data matters more. Get a shirt. That's all it's going to say. And the next team outing, he's going to be wearing that. I can see it now. We'll get a picture. We'll post it. Well, I think that is a good place to leave off. Yeah, are you in agreement?
Absolutely. Yeah.
I guess I just want to say this in closing. I don't want to sound like a broken record. When we go through times like this and you see and you log in, let's say you look at your investment accounts and you see the negative hits to your account on the short term, it could be very unnerving. And it is human psychology to assume that will continue for an extended period of time, especially if your confidence is siding with one party too, like you talked about, right?
Absolutely.
And I would recommend, and don't care on what side of the aisle you end up coming on the political spectrum, when it comes to your investments, stay on the long-term side of the equation. What I'll say is this to close. When times are great, things are never really as good as they seem. And in the opposite, when times are bad, things tend to be not as bad as they seem. So that's my kind of words of wisdom for the day. Thank you for listening to episode, we're 294 this week, aren't we?
Yes.
294.
Yep.
My goodness, time flies. The Independent Advisors Podcast, and we'll be back with you for episode 295 next week. Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.